Welcome to part two. Here's where we left off. So you should have your whiteboards up to tell me what this financial tool is. It's credit. That's right. Let's move on to our next one. Blank is the amount of money a creditor makes off of the interest for a whole year. 15 seconds. Five, four, three, two, one. Annual percentage rate. If you wrote down interest, the key term right here is whole year. Make sure you remember that. Remember, a lot of times those key terms are what will trip you up on an exam. Congratulations! We've made it to part two, where we talk about evaluating credit. Now, what's really important right now in this section is it's a lot of lecture and it's heavy, which is why I decided to do a video so that we didn't prolong it longer than we had to. What's really important is that you pay attention when I ask you to have a pair share conversation or a table conversation, or we pause the video and we have it, that we talk so that we make sure that we get through everything. Remember my comment about stickies at the beginning of class. If I'm going through this and you have a question, please write it down on a sticky note. And that way I can cover all of your questions, but we can get through all of the material today. All right, so let's talk about evaluating credit. So, what is credit worthiness? Remember, that was one of the big terms in our lesson essential question. When I say credit worthiness, I'm essentially asking, can you be loaned money? Are you a responsible enough person to be trusted with paying back money that you borrow? Or is it okay that you go to college and take the money to pay for your education to ensure that you're going to pay it back? Are you worthy of that? That's what we mean when I talk about credit worthiness. So, in other words, and this is something on your learning map I'd like you to write down. Underneath credit worthiness on the second page of your learning map, in other words, in your own words, kind of tell me what you think credit worthiness is. Should you be able to get money to pay for college or education before paying for it yourself? Should you be able to buy a car before you can pay for it? Or do you think you should have to pay for everything up front, like with cold hard cash? At your tables, let's take 30 seconds and discuss. Which of these two do you think? Do you believe in credit, or do you think you should pay cash for everything? 30 seconds, go. Okay, so before we talk about how companies determine whether or not they want to loan you money, let's talk about how you get credit in the first place, right? Before we decide if you're eligible, let's figure out where you'd go to get it. Where does credit come from? And what are some of the sources of credit? Here are some basic sources of credit: banks, retail stores, savings and loan associations, credit unions, insurance policies, finance companies. These are just some of the first things that I think of when I think of credit cards. You go to any retail store now. The other day, Ulta started selling credit cards, but you can go anywhere and get a credit card essentially now. You can go to a bank and take out a mortgage. There are mortgage companies where their entire job is just loaning you money so you can buy a house. At your table, are there any other sources of credit you can think of? Something that is really important when you're thinking about taking out credit is to ensure that you're not being taken advantage of as a borrower, right? Remember that you are being charged interest anytime you borrow money or anytime you take out, receive a service before paying for it, right? They want something out of it too. A lot of times they're going to try and take advantage of you. So here's some things you need to think of. Have you shopped around for the best deal? When you go somewhere and they're going to charge you 7% interest, that sounds really good, right? That's a pretty low interest rate. It's underneath 10. That could potentially be good. But have you seen if anywhere can offer you 5% interest or 2% interest, or the first 3 months you pay back, there is no interest, right? Have you shopped around to find out what the best deal is? Do you feel the lender pressuring you to take their loan? Right? If you're sitting in the office and they're pushing you to take their loan and no one else's, and they won't really take no for an answer, maybe there's something else going on. You shouldn't feel pressured. Remember, credit is a tool. It's supposed to help you. If you're borrowing money, it's supposed to be for your advantage. Don't let anyone take advantage of you. So if you're feeling pressured, move on. Go shop around. Do you understand the terms of the loan? Right? Have you looked at the interest rates? How long do you have to pay it back? Are there any extra fees? What are the specifics of the loan? What do you see in the fine print? Here are some common parts of a credit application. Right? So you're going to go in and you're going to apply for credit. Typically, let's use, for example, you're going to take out a loan to pay for a new car. First thing you would say is the reason for the loan: I want to buy a new car. The next, personal identification information. Where do you live? What's your name? Just basic stuff. Employment information. They want to make sure that you're going to be able to pay them back. So they want to make sure that you are being employed. My boyfriend is currently looking for a new place to rent. He had to verify his employment to make sure that he would pay it back. Mortgage and rental information. Let's say that you are applying for a mortgage. You want to make sure that you have the correct information down about that. Documentation required. Some of them have very specific requirements of things that you need to show on top of employment information or the details about the loan. Another thing is current debts. Okay, you're about to add another debt to your plate. You're about to start paying them back. How many other loans are you currently paying? This is an important thing for them to weigh when they consider lending you money to make sure that they get their money back. Credit references, people that can vouch for you paying back. Collateral. Collateral is this term of funds that you put down first to ensure that you are going to pay it back. Bank references, people that are vouching for your character and the way that you work with your funds. And then a signature and date at the bottom. So when you apply for a loan, what should you be asking? What's the annual fee of the loan? Right? How much are you going to be adding to your plate? On top of that, what's the annual percentage rate? On top of paying back the loan, what else are you going to be expected to pay? When are the payments due? How long do you have in between them? What is the minimum payment required each month? You should always pay the minimum. Is there a grace period? Let's say that you need a couple extra days to get the money together before you can pay it back. Is there a grace period, or is that immediately going to be counted against you? Are there other fees besides the annual fee of having this loan, or besides the annual percentage rate, or besides interest? What's your credit limit? How much can you spend with this loan? How much is available to you? What are the penalties for late or missing payments? Are you going to have to pay more? Is that going to be another fee? Is it going to go against your credit score? What are the terms and conditions of this credit? What else is included in the fine print? It's important that you know all of the details. Remember, it is very easy to be abused when it comes to credit. Don't be abused. Ask all of the hard questions. So, here are 2 things that you just need to know. Bankruptcy. What happens when you fail to pay your debt and don't have the means to do so anymore? You can apply for bankruptcy. Here are the 2 most common ways to apply for bankruptcy. Chapter 7. Chapter 7 completely and totally eliminates your debt. But it also has the ability to claim any of your assets, like your car, your home. If you can't pay your debt, that's fine, but we're going to take anything we can get money from you for. It also stays on your credit report for 10 years. We're going to go over credit reports in a minute, so don't panic. And any new loans are at a very high interest rate, right? The benefit of Chapter 7 is it's fast. You can get rid of your loans quickly. You're also protected by the government with it. But from now on, if you want to take out any more credit, your loans are going to be really high. And they can also, like I said, take your car and your home. Bankruptcy Chapter 13 is a forced repayment plan where you don't really have a lot of say over your finances. And it typically takes over a period of 3 to 5 years. Fortunately, because your budget, your finances are being so meticulously managed, there's a saving element. Right? You're paying back all of your debts, but you're also having money put aside as well. With Chapter 13, bankruptcy only stays on your credit report for 7 years as opposed to 10. But during this time, you are not eligible for any new credit because you're currently paying off your credit. These are the 2 most important. At your tables, I would like you to discuss, out of these 2 forms of bankruptcy, I'm going to pause the video, and I would like you to share with your table or your shoulder partner, if you had to pick between these 2, which one would you choose? Chapter 7 or Chapter 13? All right, at the bottom of your learning map, underneath evaluating credit at the very bottom, I would like you to answer this prompt. What do you believe is the most important question to ask when choosing a credit card or a loan? Go ahead and look at your how to avoid abusive lending or questions you should ask when you are looking at a loan. And I would like you to tell me which one you think is the most important. Make sure you defend your answer.